Welcome, everyone. We're ready to get started now. Tensoft is pleased to sponsor today's webcast on the topic of planning for the implementation of EITF 081 and 093. I'm Caprice Murray, the Director of Marketing and Business Development at Tensoft, and I'd like to thank you all for attending today. Just a few quick items about the agenda. We're going to start with some general information and housekeeping items. Then one of Tensoft's co-founders, Bob Scarborough, will take a few minutes to tell you about Tensoft and what we do. After that, we'll introduce today's presenter, Tony Sondhi, and then turn the floor over to him. After the presentation, Tony will answer as many questions as time permits. Please be sure to include your contact information when you submit a question if you'd like Tony to be sure to send a reply if the time runs out. For the CPE credit, if you have already, during registration, indicated that you would like CPE credit, we will be getting that to you, the CPE certificates, within about a week. They'll be emailed to you. During the presentation, if you do want to see the slides bigger, there is a button at the bottom that says Enlarge Slides. Just click on that button, and that will make them more of a full screen. And also be sure to submit questions at any time during the presentation by using the Ask a Question pane down at the lower left-hand corner of your screen. Finally, the presentation slides will be available to download. Look for the Download Slides button at the bottom of your screen. Next. Now we'd like to take just a few minutes to introduce you to Tensoft, the host for today's webcast. For that, I'll turn the meeting over to Bob Scarborough, Tensoft CEO and co-founder. Bob's been in ERP software industry for almost 25 years and has helped hundreds of software and high-tech companies improve their business processes and lower their operating costs. Bob, over to you.
Thank you, Caprice, and welcome, everybody. I'm glad everybody's here today. And for those of you not familiar with Tensoft, we're a software company who specializes in technology companies. We're headquartered in Silicon Valley, and we've delivered complete business software solutions to 125-plus technology companies. We are North America, Europe, Asia Pacific, and so on, where technology companies are located. We have a deep focus on revenue management. Our software solutions in this area support revenue, billing, and business process support. And we found that most of our customers are looking for revenue, visibility, productivity, and compliance. And by compliance, we mean a broad perspective on compliance, audit compliance, regulatory compliance, company policy compliance. Helpful to put some names to customers, and so here's a list of companies that we've worked with over the years. And it is a partial list, but it does represent the full spectrum of technology companies, from product companies to service companies to subscription to sale to complex agreement to high-volume web transactions. The RCM suite, or what we call Revenue Cycle Management Suite, is really based on a few things. And so it's, for a revenue perspective, starts with a sales transaction. And the sales transaction, this is what we mean by business process support. Basically, we look at how you go to market. And so however you sell to customers is how we need to capture your information in order to start the revenue management process. That's really where productivity comes in. We need to match our solutions to your go-to-market model or models. It's often the number of people have more than one model. The transactions can be based on your website, your CRM system, your ERP, your enterprise resource planning system. We have a enterprise agreement or contract management system in our product. It can be sell-through or channel models if you wanted to get more complex than this. But we basically have a sales transaction created to start the revenue management process. For us, taking the transaction as a starting point, we really look at applying policy, and we use a concept of document, so each document type can have a separate policy. And for revenue-based determination, we're really looking at taking the transaction, whether it's contract-based revenue, an individual sale, or a multi-element transaction, and starting from what should be the revenue basis for that. Do we need to apply compliance or regulatory rules? We're talking about the EITF 0801 today. And then from there, moving to specific rules, subledger analysis, revenue recognition. So this is a flow diagram of the general transaction flow, and it starts with the big arrow on the left. And so the big arrow on the left is really that, again, that business model support. So website, contract. But basically these transactions are captured, and then we really put them into an intermediate point, because part of the point of today's session and part of the point that a lot of people know in terms of complexity here is that the sales transaction as a start point, whatever that transaction may be, where we need to look at compliance policies, we need to look at revenue methods, and so on. And so these policies and restatement of that create a revenue contract or a revenue transaction separate or apart from or related to the sales transaction. The revenue transaction then updates the subledger, updates your analysis and reporting, and then goes into your ERP. And so a Tensoft RCM suite is built to handle this complexity, and basically a number of the complexities related to revenue, billing, and business process support for technology companies. So that's a brief introduction on us, and what we'd like to do is I have the pleasure today of introducing Tony Sondhi, and Tony is an expert in every sense of the word. Tensoft's committed to providing Tensoft revenue recognition and contract management software to our customers, but we understand that really this is just part of the total solution. Another element of managing revenue recognition is understanding the rules and the standards affecting your business. And with that in mind, we work with leaders in the industry, and there is no leader other than, Tony is a preeminent leader in this industry. He's currently a member of the Emerging Issues Task Force, or EITF, of the Financial Accounting Standards Board, its Agenda Committee, and its 2008 work group on the EITF 0801. He's also a member of the Expert Advisory Panel on Fair Value of International Accounting Standards Board, the IASB, and has served as a subject matter expert and expert witness on a number of regulatory boards, committees, and other public hearings. Tony authored the 2006 to 2009 of the CCH Revenue Recognition Guide, the analysis and use of financial statements, and recommended text for Chartered Financial Analysts, CFA program. He also serves on the board of directors of an investment advisory services firm and a charitable foundation. He acts as an advisor to several U.S. and foreign companies, served as an expert witness in many financial reporting issues. Mr. Sondhi provides consulting in areas for which he is a subject matter expert, including revenue recognition practices in the software industry and contracting industries, revenue arrangements with multiple deliverables, consolidation policy issues related to variable interest entities, financial reporting requirements for foreign operations, securitization and transfers of financial assets, credit analysis, and the analysis of company-wide financial reporting decisions. I'm sure many of you are familiar with Mr. Sondhi's work and experience and know he's recognized as an internationally renowned expert in the field of revenue recognition and contract management. We're pleased to have him with us today's webinar, and it's my pleasure to introduce today's presenter, Mr. Tony Sondhi of AC Sondhi & Associates. Thank you, Tony.
Thank you, Bob. Appreciate your kind words. Let's get to work since we've got quite a few people looking forward to this. So as Caprice has said, we're talking about implementation issues and concerns that one will confront, and many of you are confronting at the moment, with respect to EITF 0801, and it's likely that quite a few of the people here are also looking at EITF 093. The topic for today is one component of this implementation process, and that is the pricing information that you need for allocation purposes. So what I've chosen to do here is to begin with a discussion of and to go through a discussion of the valuation hierarchy that we have to deal with in EITF 081093. But I think that the way to really look at this entire issue is to start with the very first valuation methodology that all of us have looked at. So SOP 97-2 starts off by saying that for separation and allocation in a multiple element arrangement, you need vendor-specific objective evidence of the fair value of a particular or of a specific deliverable. Now, that's the basic principle, or rather, the basic definition, the fundamental principle of VISO of fair value is that it is the price that is charged when that particular deliverable is sold separately. And I'm sure you've, if not everyone there, most of you on this webcast have heard of that. And I'm sure you're also aware that there is an exception, and that is for an element that you have not yet sold separately. Management having the relevant authority may establish a price which would serve as VISO of fair value. What's very important to keep in mind with respect to this exception is that the price that you choose needs to have two characteristics. One, that it should be probable that once you've established the price, it will not change before separate introduction into the marketplace. And another characteristic that I think is very important is that you don't want to do this too soon, because you've got to do it within a fairly short time prior to actually starting to sell that particular item, deliverable, all by itself. Now, please note that this exception in practice has also been applied to new products. So although the standard itself in paragraph 10, which I quote on this slide, just simply says the exception applies to an element that's not yet being sold separately. But as I said, it certainly has been applied to far more than just the items that you were selling in the past in a bundled arrangement and have now decided to sell separately. Now, what's very important then is to consider the types of evidence that you cannot use, or what does not constitute VISO of fair value. And interestingly enough, the standard SOP 97-2 actually listed 4 types of prices that you may not use as VISO of fair value. So the stated or listed prices in a contract, you cannot use, at least for software, surrogate prices. In other words, you can't use third-party evidence. Now, as you're all aware, that third-party evidence certainly is an acceptable type of evidence for the estimated selling price, or the selling price itself, rather, I should say, not the estimated selling price, in 081. But we'll come to that in just a moment. Now, notice that I've highlighted, or at least I've italicized, the third and the fourth type of price that you may not use. So prices that are based on methods such as cost plus some kind of profit margin. And the reason generally given for that is that we don't know how to define normal, but that you're probably aware of. The fourth bullet point that I have here is if you can't use a price based on a single profit margin, you certainly couldn't do it for a combined margin. Now, please keep in mind that although these are not considered sufficient evidence of fair value for software transactions, take a look at, as you'll see in a few moments, that for non-software transactions, this is actually how the EITF has defined selling prices. Okay? So this is the basic structure that we had before we went to EITF 0021 and then subsequently amended 0021 with and issued EITF 081. By the way, just as an aside, I was not serving on the EITF when they wrote EITF 0021, so you can't blame me for that one. Okay. Now, with respect to VISO of fair value, there's a certain amount of documentation required with respect to this evidence. And effectively, over the years, a lot of people who've had to use this have complained because there is a rather significant and to many people an onerous burden with respect to data collection and cost of sustaining that evidence. And probably the most important one is that it certainly severely constrains discounting practices. But there's another argument that's been leveled against VISO of fair value, and that is economic substance of transactions is also distorted because very often when you don't have sufficient VISO of fair value, then you cannot recognize some or all of the arrangement consideration that you believe attaches to items you've already delivered. And that certainly creates an issue. Whether that's true or not is a different thing, and I think it's a function of the types of contracts you have. It's a function of terms and conditions in the contract, and it also is affected by the type of industry you're looking at. So even within software, there are places where there may be a distortion, but it's also possible there are a large number of cases where there may not be any distortion. Now, then we come to EITF 0021, because note, as I said a few moments ago, that SOP 97-2 and therefore the VISO of fair value requirements effectively applied to software transactions. EITF 0021 then issued a set of standards that applied to non-software transactions, and in general they applied in those cases where you did not have other literature that had either or both separation and allocation principles. So let's take a look at what EITF 0021 gave us. It started off by saying that separation and allocation of multiple element arrangement should be a function of objective and reliable evidence of fair value. Now, 21 did not specifically define objective and reliable evidence of fair value. Instead, what happened was that in practice, in essence, many people considered objective and reliable evidence of fair value to be tantamount to VISO of fair value as defined in 97-2. Now, what's interesting is that please keep in mind that if you don't have VISO of fair value, you could certainly come up with evidence based on vendor-specific standalone sales, which basically is how you would come up with VISO of fair value anyway. But more importantly, in a rather significant, I should say, departure from SOP 97-2, the EITF in issuing 0021 said that unlike software, non-software deliverables such as certain kinds of hardware, certain services, etc., may actually be effectively comparable to what other vendors in the marketplace are offering, and therefore they made a rather significant change, and that is 0021 permitted the use of third-party evidence. Recall that in 97-2 you were not allowed to do that. Now, third-party evidence, I give you a definition here. The objective is that, in essence, you're looking at the price at which a competing vendor sells the same item or a comparable item. And then it spells out the different characteristics that one needs to use in order to establish comparability. Now, so in addition to quality, features, brand recognition, value, etc., you also need to think about transaction size and so on. Now, it also, of course, always matters how many separate transactions do you have that help you set up sufficient evidence. Now, the problem, of course, with third-party evidence is that, generally speaking, you're not going to find actual transaction and pricing data from other vendors. I mean, the point is that vendors may publish, may even make public, in a sense, a price list. But there's no guarantee that they're actually selling at that price. Right? So in that sense, third-party evidence, at least to me, is sort of a restrictive principle because it's not always easy enough or possible to find it in a cost-effective fashion. So in that sense, although third-party evidence is used, and you may use it according to 21, it's not clear that you're always going to be able to find it. Now, so fundamentally, one of the issues you want to think about is, so what is the difference between VISO fair value in 97.2, objective and reliable evidence of fair value, and then the vendor-specific standalone sales? So the point is that I think in practice, 97-2 may have become the most, at least in this, if you think of it in these three possibilities, it was the most difficult one in terms of the amount of documentation required, the kind of evidence you needed, and so on. So in that sense, as you go from 97-2 to objective and reliable evidence to vendor-specific standalone transactions, the degree of rigor applied to develop the price and the evidence, in other words, that declined. So I think that in essence, what would make the most sense, or what was the most reliable in terms of allocations, and therefore the information that helped you forecast revenues best, is most likely the VISO fair value, then objective and reliable evidence, and so on. Now we come to EITF 081. And EITF 081, the EITF received a lot of requests to reconsider EITF 0021. And the main reason was the same one that I gave you earlier, and that is that many people, many companies feel that in their transactions we're not presenting the economic substance of the transaction because of the extent to which there's a deferral. Now, whether that's true or not is, really, I think, something for an issue to be considered in a different webcast, because I don't want to get into that right now. What I'd like to do, focus here, is what did the EITF do with respect to that complaint? Fundamentally, as you can see on your slides up there, what the EITF has done in EITF 081 is said, okay, so there is a problem with finding sufficient evidence of fair value. So they changed that to selling prices. So now what you do is you're going to use, for allocation purposes, VISO of the selling price. Notice that I said for allocation purposes because we don't use it for separation anymore. Now, the point, therefore, is that we're going to use selling prices for allocation, and those selling prices are fundamentally based on entity-specific assumptions. In other words, the FASB tells us that it's at the expense of information you could get from the marketplace participant. But of course, it also goes on to say that the vendor should consider market conditions as well as entity-specific factors. Now, if you think of an estimated selling price as being made up of three components, the cost, the profit margin, and a discount policy, then clearly all three of them are going to be affected to varying degrees, of course, but they're all going to be affected by market factors. Your profit margin is limited to what your place in the market will allow you to earn. The discounting may be forced upon you by a competitor, may be forced upon you by technological change. So there are many conditions in which market conditions will certainly, many cases where the market conditions will affect your development of the estimated selling price. So yes, in that sense, the market-specific factors are considered, and therefore they're considered in addition to entity-specific factors. Now, there are three other things that are important with respect to 081. Unlike EITF 0021, 081 requires that you use the relative selling price method to allocate the total arrangement consideration to all of the deliverables in the arrangement. Now, which basically means that there is, much to the chagrin and probably more than that of a lot of people, you're no longer permitted to use the residual method. You see, implicit in this is the argument that you can get VSO of selling price. Failing that, you should be able to develop it from third-party evidence. And then failing that, you always have, as a last resort, if you wish, but not really, an estimated selling price. Okay? Now, the standard, the EITF 081, goes on to say that you should develop VSO off the selling price or use third-party evidence so long as you use all reasonably available information without the expenditure of undue cost and effort. But please keep in mind the EITF did not describe or explain what they meant by undue cost and effort. Now, the amendment also does not provide any specific methodology, guidance, or anything that you have to use to develop your best estimate of the selling price. The objective is that you come up with a selling price that reflects the price at which you would sell that particular deliverable all on its own. So you see, the problem with that argument, though, is that, if you never intend to sell that item all on its own, then you wouldn't be considering that. Or what would your estimated selling price be, since you don't expect to sell it all by itself? So fundamentally, as I said, the idea is that the selling price you come up with is consistent with the price at which deliverable is expected to be sold all by itself. So some questions. Will the estimated selling price provide a reliable selling price of the undelivered units? See, the problem is that undelivered units at any given point in time could certainly be the units that you've been selling in the past. If you have a fair amount of experience with those transactions, maybe you can develop a reasonably reliable estimate of selling price. But what about intellectual property? What about stuff that you've never sold before? What about products and services that you want to approach the market with? Right? You want to break into a particular market. You've never sold it before, and let's say it's also possible that you've come up with a product that other people don't have. How would you set the prices? So in a sense, I don't think it's always going to be possible to come up with the best estimate of selling price. Now, in the task force, the FASB staff response was that we'll get much better separation, much more economic reporting of revenue, simply because a lot of different factors will be considered. Now, I didn't see any evidence of this. I think this is an assertion. We'll have to see what the results tell us in the next few months, because everybody has to, will have adopted it, and the first quarter will be a pretty good set of results to observe what has happened. Now, how does one ensure that your estimated selling prices are reliable? You see, the point is that if you want to be able to forecast how much money you're going to make in the future, you want the allocations and therefore the prices that you use to be reliable. So I think whether there's a requirement to do so or not externally, I think for internal purposes, management really needs to ensure that they've got prices that make sense and that the allocations actually correctly reflect what you will earn once the remaining obligations are complete. So you see, with respect to undelivered elements, it's just as important for internal management as it is for outside investors to ensure that this is being done correctly in terms of both amount and timing. But I do have a concern, and that is, let's say you had a sort of a tenuous hold on objective and reliable evidence of fair value. And let's say you have a tenuous hold on VSO of selling prices simply because there's a lot of competition. Some of your competitors have introduced new features, functionality that you haven't gotten to yet. For example, there could be many reasons. But the problem is that it's quite likely you're not going to be able to sustain VSO of selling price under those circumstances. If that's the case, what are you going to do? It's quite likely that you'll use an estimated selling price. The question is, will the estimated selling prices that companies graduate to or drift towards, will those provide us with information that's reliable? How will it affect forecasting? How will it affect our assessment of capital allocation? Right? Because if you don't do allocation correctly, you may actually mistakenly think one product or service is more profitable than the others. And if you make that mistake, it's going to be fairly expensive, most likely. So in that sense, what I'm saying here is that it appears to me there's some pressure on VSO, and chances are we're going to end up with a lot more estimated selling prices. The other point I think is very important is that the audit committee of the board of directors at your company has to be very concerned about how reliable the estimated selling prices are, and therefore how reliable the allocations are. So those are some of the things that we need to watch out for very carefully. Okay? Now, effectively, therefore, these are the issues that I wanted to raise with respect to the different types of prices and some of the limitations that we have. So at this point, I'm happy to take questions.
Tony, thank you so much. We do have some questions that are coming in, and again, if you would like to submit a question, do so at the bottom of your screen. There is a tab that says Ask a Question. Just enter it there, and we'll go ahead and start answering the ones that are coming in. The first one I have, Tony, is if a range of ESP is used to recognize revenue, but the actual turns out to be out of the range, what do you do with the difference?
The normal practice, and this is developed it's used both in software transactions and outside of software transactions, is that if the actual price is below the bottom of the range, then for the undelivered element, you would take out effectively, in other words, you'd carve out at least up to the bottom of the range. But if the actual price for a particular deliverable is above the range, the top of the range, then generally speaking, you just carve out the amount that's stated rather than bringing it down to the top of the range. But that's normally the practice.
All right. Thank you, Tony. And another question. For a company in which discounts are frequent and the product price depends on customer size, how do we establish a fixed ESP?
Well, there are two things that suggest themselves directly. One is that if there's a wide range of discounts, one possibility might be to segment it by the level of the discount that you offer different kinds of customers. Alternatively, it may simply be transaction size that determines the amount of the discount. So effectively, you could use or stratify your transactions on the basis of the different transaction sizes. Now, you don't have to have too many. You're probably going to lose that, and it also becomes onerous. But you should be able to create or develop bands of discounts that you can then, or discounts or customer types, transaction size, in other words, that allows you to determine a separate estimated selling price for the 2, 3, 4, whatever number is strata that you come up with for your discounts and or your customers.
Tony, next question is, particular audit firms allow for the use of a contractually stated renewal rate as evidence of VSOE of FV for PCS. Is this acceptable in the view of the EITF?
Well, the first thing is that the stated renewal rate, which can be used as evidence of VSO fair value for PCS, that applies to software transactions. Although I've seen something of an increase in PCS or something that is fundamentally similar to PCS being offered for non-software deliverables. So having said that, let's go back to the basic, what the question said. Yes, audit firms do permit that simply because that's part of the standard. The standard does allow companies to use VSO fair value for PCS, the stated renewal rate. Now, there's a series of, I think there's a total of 5 technical practice aids, which are implementation guidance that help you better understand what characteristics that stated renewal rate must have in order to qualify as sufficient VSO fair value. And it would be a good idea to take a look at those. And, of course, it's also possible that your auditors will ask you to really demonstrate that you're sticking to that stated renewal rate. So in other words, for some auditors, the mere statement that you have a stated renewal rate is insufficient, because it's possible that although you have a stated renewal rate, if a customer asks for concessions, discounts, you may be offering them. Then the question becomes, how frequent? What is that your policy? So in other words, do you actually stick to a stated renewal rate? How far are you from that? So some of those issues have to be considered, but it's perfectly acceptable because it's part of the standard itself.
Thank you. Next question is, can you comment on whether any revenue can be recognized earlier related PCS when PCS has VSOE or through the mere allocation of relative selling price? Meaning, is PCS considered contingent on delivery of the service, and therefore it should not be recognized any earlier than when delivered?
Priest, that's what I call a multiple element question.
Yes, I think so.
I think it's qualified. So I'm actually going to do some separation and allocation myself as I answer that. The first point is that generally speaking, what happens, if I understand the question correctly, so please feel free to the listener who sent that, please feel free to correct it if I'm wrong. The point is that, let's say, if we're talking about software transactions, you deliver software, and there's some service that you've also sold, and then you've got PCS. So there are 3 deliverables in the arrangement, let's say. If that's the case, your first question, of course, is, can the customer use the software without those services? Right? I mean, if the customer does not benefit from the software until those services are done, then there are some implications for revenue recognition. On the other hand, even if those services, whether they are essential to the functionality of the software or not, what may happen is that the software is delivered, say, on the 1st of January. Services are going to take you 3 months. Any when and if available upgrades, enhancements that you come up with, the vendor develops during those first 3 months, chances are they'll provide those to the customer, which suggests that PCS begins upon delivery of the software. So that's what you have to ask yourself. First question, are the services essential to functionality? Second question, as I said, with respect to the PCS, is it your practice to provide the post-contract support before the customer can start using the software? Or, for example, in SaaS parlance, I could say before the customer goes live. Right. So if that's the case, those are the questions that you have to ask yourself. In general, I find that companies do start recognizing PCS from the point in time where the software is delivered, even when the services are essential. That has an impact on the amount and timing of the recognition of the revenue that attaches to the software and to those services. But that's a separate question.
Thank you, Tony. The next question is, in a situation where software is sold with undelivered hardware, undelivered service hours, and undelivered third-party add-on software, not essential to the function of the other software, if a new undelivered third-party software product is sold in the arrangement, does the new undelivered third-party software product fall under EITF 081, which would allow TPE, or does it remain under 97.2 VSOE?
Basically, regardless of whether it's your software product or it's a third-party software product, so long as it is a software product or the software deliverable, which would include PCS, for example, any software and software-related deliverables remain subject to 97.2. They do not, under at least the scenario you explained, fall into 081. Now, the only thing I can say, although your question did not say anything like this, the issue I would raise is it software that works with some tangible product to provide the essential functionality? If that's the case, then you would be subject to 093. You'd be carved out that particular software that works with hardware to provide the essential functionality. That would be carved out of the bundled arrangement, and then it would be subject to 081, 093. But if it's only software, the way you've said it or you've written your question, then it's going to remain in 97.2, and therefore third-party evidence is not applicable.
Thank you, Tony. The next question is, with respect to maintenance sold in the second, third, or fourth year after the perpetual license is sold, is that considered sold by itself? I ask because it would never be sold if the original license was never sold.
Yes, actually, clearly nobody would buy maintenance if they hadn't initially purchased software. Although it might be interesting if we could find somebody who was willing to buy maintenance without buying the software. But I agree, that wouldn't happen. However, the point is that all subsequent transactions with that maintenance PCS, whatever you want to call it, those would certainly be standalone transactions. So they are being sold by themselves. And in fact, this is one of the main sort of pillars of being able to come up with VSO of fair value for PCS, because it is renewed, and it is renewed all by itself. Very often for software companies, the real difficulty they have is not with respect to VSO of PCS. The problem is they never sell the software all by itself. So that's why the software accounting standard permits the residual method, because software is never sold by itself in many cases. So in that sense, that's the distinction between 97-2 and EITF 081. Now, the other thing I should point out is that the revenue recognition exposure draft that's been issued recently by the FASB and the IASB, that exposure draft effectively eliminates the special treatment or requirements for 97.2. So once that exposure draft becomes the standard, then then software and non-software products will be treated similarly.
Thank you, Tony. The next question is, how does estimated selling price get impacted by management changes in pricing? Audit evidence? Question mark.
Well, I guess probably the best answer I could give to that is that it certainly can be affected. And most likely the reason is that when management changes, the new management may come in and they may, for example, change the method they're using to allocate costs. The previous management may have allocated R&D, for example, in one way, indirect costs in one way, but the new management may decide to do it differently. The other possibility, of course, is that new management may decide that a particular product isn't doing as well, and therefore they may want to emphasize it or change the discounts on it or determine that they're willing to live with a different profit margin. So effectively what happens is that you can certainly have management changes affecting the price that you're using. And it's going to be at the forefront when we start seeing more and more adoptions of 081 with management changes coming up. And, you know, in that sense, allocations may change over time. Management's view of whether the delivered item has standalone value may change over time. So in other words, both separation and allocation could change. And some of the companies that I'm going to be watching for is, you know, if you've been looking at the newspapers the last week and a half or so, a number of takeovers have been announced. And this last week in particular, maybe yesterday more than anything else, was a pretty rich day in terms of data for the types of companies that have been acquired but normally sell multiple element arrangements. So there will be differences in their allocations. There will be differences in the amount and timing of revenue recognition. So I'd say yes, that management change can have a profound effect on the estimated selling price.
Thank you, Tony. Next question is, there seems to be a higher standard for making estimates in this area versus other accounting estimates, such as accruals or impairments. Why is that, and does it make sense?
Well, I'm not sure that that's the case. I think that the accruals, for example, if you think about, say, returns, bad debt expense, those kinds of things, those accruals actually have to meet a reliability standard. The estimated selling price in 081, there is no reliability standard on that. Now, although I think the question is certainly accurate and correct in the sense that when you think about 97-2. Now, in part, one could argue that 97-2 is a more stringent and restrictive standard, requires a lot more evidence and so on, and documentation. But that's largely because I think initially, at least, 97-2 was meant to be an abuse prevention standard. And abuse prevention standards, generally speaking, tend to be more constricting than otherwise because you're trying to prevent people from doing certain things. On the other hand, I think it's worth asking whether software revenue recognition today continues to need a different set of rules. Obviously, the two boards have decided it through the exposure draft by including software along with all the other types of deliverables. They have decided, they've effectively said that they don't think software transactions are all that different, and therefore they should be given the same accounting treatment as any other transaction or deliverable would.
Thank you, Tony. Another question, reassessing reasonableness of estimated ranges. Isn't that an arbitrary bright line test? Who defines the range?
Well, I guess let's take that in parts. The first thing is, I agree. Ranges are arbitrary. I agree they're bright lines. What makes them work, and or if you want, what makes them palatable, is that at least in 081, and for 093 types of transactions, the same standard applies to 081, at least in 081, these are set by management. So in that sense, even though they're bright lines, they may, you may be okay with them because management gets to set them. The concern for management should be that if they succumb to the desire to front-load revenues, then the question they have to ask themselves, will they remain aware enough of what they've done to not then make mistakes in terms of the allocation of scarce resources or allocation of capital? You see, because if you front-load revenues, then you tell yourself you've got a different amount and timing of revenues. And if you believe in that, and it's good if it properly reflects the value of the different components within a bundled arrangement. But if it essentially results in front-loading of revenue, then I think you're going to have a lot of problems going forward. And it's also possible, as I said, that you may end up incorrectly allocating prices and arrangement consideration. And that would be very harmful in the long run.
Thanks, Tony. The next question is, are the impacts of these new rules an indication of what all industries will experience with the proposed revenue recognition rules?
Well, I think that it's fair to say that EITF 081 and EITF 093 changes are a small component of what we're all going to face with the proposed revenue recognition standard. You see, the fundamental reason for that is that 081 and 093 change one aspect. Admittedly, it's a very important aspect, and it permeates it has pervasive influence on separation allocation. So yes, I don't mean to understate that, but it remains correct, I think, to say that the 081, 093 changes are just a small part, you see, because basically what happens with the new accounting standard that's being proposed, that accounting standard effectively is going to change revenue recognition in far more areas and far more complex ways. So I don't think that 081 is a sufficient indicator of how much change will come.
Thank you, Tony.
Caprice,
Yeah.
I just switched the slides over to the seminar.
Oh, that's
schedule, yeah.
perfect. And do you have we have a few more minutes. Will you take a few more questions while folks look over the spring seminar schedule?
Certainly, and I think either you or Bob said earlier, I will definitely get back to the questions that, we've not been able to. I'll write to everyone and so on. But please go ahead. And while you're doing that, please take a look for the attendees at the seminar schedule. There are two slides. Go ahead, Caprice.
All right. Next question is for a software as a service company. A contract begins now and promises future new capabilities in the software application, future releases with a table of estimated dates for delivery, but no consequences if the established delivery date is not met. Absent VSOE and TPE, does one need to develop ESP for the future deliverables and delay revenue recognition accordingly?
Well, it's a function of how you write the SaaS agreement and whether additional payments are called for and so on. But generally speaking, a SaaS deliverable is recognized ratably. But if it qualifies as a separate deliverable, and it may, the way that question was framed, those future deliverables may qualify. If that's the case, then yes, you would have to carve out a portion of the revenue, but you'd have to see. So it really is a function of how the terms are framed, I would have to say. But suffice to say that there is a possibility that you will have to defer something, even in a SaaS arrangement.
Thank you, Tony. If a company sells a term license and separately sells services, can the services be recognized over the service period versus over the term?
That depends on the nature of those services and how they relate to the rest of the arrangement. Excuse me. If the services are separable, it's one thing. Certain services such as setup, for example, those you have to evaluate to determine whether they should be recognized over the term of the relationship with the customer rather than just the term of services or the contractual term. And I can tell you that there's some emphasis by the audit firms and the regulators on doing that far more carefully. I mean, SAB 104 introduced a lot more rigor into that anyway, but clearly that rigor continues today. So you do have to be careful, and that requires understanding the nature of the relationship between the services and the other deliverables in the arrangement.
Thank you, Tony. And one more question. There is a debate in the accounting firms around companies who had VSOE under the residual method for undelivered PCS, that they would not be able to recognize any more upfront revenue under the new rules due to the fact that PCS is contingent upon the delivery. So the relative selling price has a VSOE floor. I guess I don't see a question mark, but do you have a comment on that?
Well, there may be a debate, but I don't think that I haven't seen any resolution of that yet, so I don't know that that's necessarily going to change practice. But, it's something to keep an eye open, and we'll take a look at it.
Certainly. Well, thanks very much, Tony. Would you like to say a few things about the seminar schedule, and then I think our time is up.
Yes, I just wanted to mention that I have, as you can see from those last two slides, a series of certainly seminars that I've offered in the past, the advanced topics, the 081093, and the software as a service. However, we do have several new ones, and particularly the revenue recognition exposure draft sessions, which are half day, to give you an idea of where the system where the standards seem to be going, and also the same for leasing. And then there are a series of other seminars that I haven't listed here that are also worth thinking about on acquisition accounting, for example, particularly acquisition accounting in software as a service industry. So there are some specialized courses as well, and I invite you to visit my website, acsondhi.com, and look forward to seeing you at a seminar in the future. Thank you, Caprice.
Thanks, Tony. Thanks very much for your time today, and thank you, everyone, for attending. We will be getting the CPE certificates out in the next week. They'll be emailed to you if you either indicated that you wanted to receive one, or if you email me, we'll be sure you get one. The slides are available for download, and we have recorded today's presentation. That will be available in a few days. We'll send you a note about that, or you'll be able to access it from the Tensoft Resource Center. Any questions, please contact me, caprice@tensoft.com. And again, thank you all for attending. And Tony, thank you very much for the wonderful presentation today.